It has been a brutal run for REITs, the worst on record, underperforming the S&P 500 by 70% since the Fed started hiking rates. But David Auerbach says that pain may be the setup. The chief investment officer at Hoya Capital Real Estate joins us now, and he says balance sheets are sound, new supply is limited, and data centers are the only bright spot. David, I guess, they can't really go much further down if they've underperformed by that much.
One would like to think so. I like to say that the REITs are like your graduating class in high school. You had the top 10%, the valedictorian, the REITs in the S&P 500. You had the bottom 10%, the bullies, the troublemakers, the REITs that have cut dividends or over-levered. But what's really to focus on is that middle part of the curve, the students that go under the radar, the small and mid-cap REITs that are putting up solid results, raising dividends. There's really good stories that are out there. From a very high level of the 100+ REITs that announced full year earnings guidance, just in this past quarter, more than 2/3 raised their guidance. More than 60% of the REITs raised their net operating income guidance. Year to date, over 30 REITs have raised their dividends. It's a slow and steady race. When people think about REITs, they're like, oh, REITs are interest rate sensitive. Well, the end consumer that uses these properties and products doesn't think about interest rates when they're interacting with these properties. And so as a result, we're using REITs every single day. We are sitting in a REIT-owned property right now, as an example. To watch this video on YouTube later today, you're using a REIT. So we interact with REITs so much that I feel like the overall sector gets lost in the negative headlines where there's some really good stories that are out there.
But you write about this idea that there are fewer public REITs right now, and something Matt and I have talked a lot about the overall equity market, how it's been shrinking and the amount of public companies that are listed has been less and less. How acute is that problem in REITs, and what does it mean about the opportunity set that you see?
Boy, it's been a crazy quarter. If you go back to 2022, coming out of this COVID cycle, 36 REITs have either explored options, merged, or gone away. In the past couple of months alone, more than 10 REITs are in play. So it presents opportunities for management teams to unlock value for their shareholders, whether it's accessing the debt market, and the debt markets are wide open for REITs right now. Issuing preferred stocks. We just saw the second REIT launch the second equity preferred offering in years just this morning. But also less properties that are out there, more in private hands. So there is some give and take that comes with that.
In terms of the property types that look healthiest, I mean, it's always been student housing, right? Medical offices, I guess senior living, but now you add data centers to it. Is that the full list?
So for sure, senior housing. That is probably the top of the list of all of those
Even
sectors.
better than university dorms.
There is no more student housing publicly traded REITs. Blackstone bought the last one just a couple of years ago. But when you think about senior housing, look, we're a couple of minutes older than when we started this conversation. There's a lack of supply for the amount of baby boomers and Gen X and folks that are going to be living in these properties down the road. So that is the number one.
Gen X isn't there yet, dude. Chill out with that.
But they're thinking ahead. Data centers, obviously AI, every single sector has AI implications, for sure, data centers. But then there's other great sectors. Billboards, a great example. Warren Buffett, last quarterly earnings release. Everybody talked about how he invested in, I believe it was in D.R. Horton, but what they didn't focus on was that they established a stake in Lamar Advertising Outdoor, a billboard REIT, LAMR. So that's another good example. Retail. You guys have Stephen Yalof from Tanger on as guests on your channel very frequently, and he's talking about exponential offerings, double-digit rent growth that they're seeing. The high-end consumer and those properties, whether it's luxury hotel, retail, et cetera, they are kicking butt and taking names. It's the other end of the spectrum that are seeing some of those issues with weakness.
When it comes to residential housing, it's been a really big focus of this administration in trying to promote affordability, considering how big of a theme it is. In recent days, we've had the idea of a 50-year mortgage floated or a portable mortgage being floated as well. How much of that would alter the housing space, and would it make it more or less attractive to you as an investor?
I would say on the surface, it might be a positive with an asterisk and a but, because the key issue here is housing affordability. Put it simply, homes are unaffordable to the average consumer. Mortgage rates are still highly elevated. We still see the opportunity, frankly, in the apartment REITs, in the single-family rental REITs. Single-family is a good example because you look at all of the institutional capital that's chasing that sector right now. If we can start producing product that makes it more affordable for the end consumer to live in these properties, then we can finally start tapping into this housing demand that's out there. I think the 50-year mortgage or the portable mortgage is just, frankly, one little arrow in the entire quiver of things that they can do to make it more affordable for consumers.
But, I mean, if you continue to make it a 50-year mortgage, then a 100-year mortgage, then a 1,000-year, like past your death, we're just putting a Band-Aid on this economic problem that we have, right? What do you think of the broader economy? Everyone's talking about the K-shaped economy. The lower half is not able to afford food anymore. What does that mean for your business?
It definitely has severe implications. There's no question about it. But again, you have to peel back the layers of the onion to look at it from the REIT fundamentals perspective. And so as a result, you're right, there are some issues. I think for a lot of these management teams, the job, though, is to keep the blinders on, figure out ways, how do we maximize revenue growth, minimize our expense growth, and push out as much of our net income or dividends as possible to shareholders. Look, REITs have long-term leases in place. You want a short lease, go rent a hotel room for one night. But when you take down an office lease at One Vanderbilt down the street or the Empire State Building, which you can buy, by the way, for $7 a share right now, the Empire State Building. These leases are 10, 25, 50 years, Safehold, ground lease, 99-year lease term as an example. So I think when you look at the embedded rent growth that's in place with a lot of these leases, this provides that income stream that investors are looking for.
Why do you like retail with all of this? That's an interesting one, especially K-shaped economy, people are spending less, and you have the longer term trend of people just not going in person to stores as much. Why is that an attractive industry?
I think when you look at, so a great example is Simon Property Group, the 800-pound gorilla in the mall space. They just raised their dividend for the 14th time coming out of 2022. These guys are trying to figure out what tenants can we put in place that we can't replicate online. We're not going to showroom the product necessarily, but also meet needs to our consumers. As a good example, Netflix. Netflix is launching this entertainment concept at a handful of malls across the country. And there's other examples of some of these experiential retailer properties that are trying to draw in families. How can I draw in a family to come hang out at my property for 10 hours in a given day? So a Netflix opportunity, you have Build-A-Bear or American Dollar, some of these other things that are trying to draw the family to the store.
I think Build-A-Bear has had excellent returns recently, so point very well taken. Dave, thank you so much for joining us. That's Dave Auerbach of Hoya Capital. A quick check on